Hey guys, Mike here. So obviously the stock market continues to grind higher and higher. And so, the big question is, inflation numbers keep coming out. They're terrible. How come it hadn't even put a dent in the stock market, let alone crash the stock market? And so we're going to talk about that. We're going to talk about Jerome Powell, who speaks at 2 p.m. tomorrow, and how that's going to affect the market, because he probably most likely is going to have a huge announcement, which we've been waiting on for months. And then we're going to talk about, obviously, some charts, which I went through and looked at what happens when Jerome Powell speaks at 2 p.m. And it was kind of surprising what I found. And so you're going to see that. And also, what's really behind moving the market higher and why it continues to grind higher and most likely will in the next few months, okay? And so before we get into it, if you're looking to make some passive income, as I do, then don't forget BlockFi increased their interest rates to 9% on your stable coins, on most of them. And then on Tether, you can get 9.5%, which is absolutely huge. If you do want to sign up for the credit card to earn 1.5% back in Bitcoin every purchase, you can do that as well. All you got to do is hit the link in the description below. There's two of them, one with the credit card and one for the BlockFi account. And I've been taking advantage of both those opportunities and earning passive income, so I've enjoyed that. And so, first I want to get into, is inflation still transitory, which means it's just a fancy word for temporary, which means weeks or months, okay? And we're talking about a few months. And so let's ask somebody who's kind of an expert in this realm.
Have you stopped using the T word, the transitory word, which we don't hear as much from Fed Chair Powell and some of the other Fed members?
Well, I think it's still fair to use it in the sense that even if it doesn't mean a month or two, it means a little bit longer than that.
And what Janet was trying to say is, no, it is not transitory. Even her and Jerome Powell said this is going to continue on into mid-2022 at least. That will make it over a year from when they started saying it was transitory. So the other question is, Janet, how's those year-over-year inflation numbers going to be looking in the next month or two?
Year-over-year inflation rates remain high and will for some time, simply because of what's already happened in the first months of the year.
And just looking at where we're at on this is kind of a gauge I like to look at. And so U.S. inflation pressure, 12-month rate of inflation, you can see right here, this is the CPI, which is what the Fed loves to use. And you can see the 10-year average is 1. We're at a 5 basically on this gauge. And then when you include food and energy, 10-year average is almost between a 1 and 2, and we're at a 4. And so, of course, the big question is for tomorrow at 2 p.m. when Jerome Powell speaks, what are the expectations of what he's going to say? And so let's ask Steve here what the survey tells us.
It is the time amid heightened concern, Becky, about inflation. Respondents to the CNBC Fed survey think the Fed is going to announce a decision to taper tomorrow, and it's going to start hiking interest rates much sooner than previously forecast. Respondents too overwhelmingly believe the decision to reduce asset purchase will not only be announced in tomorrow's policy statement, but that the taper is going to begin this month. It's going to proceed at a $15 billion monthly pace. That's going to end purchases in May of 2022. The big change, the 25 respondents now forecast the first rate hike in September. That compares with December in the last survey. But 44% think it's going to come as soon as July. Inflation replacing COVID as the number one threat to the economy in the survey, and 60% think it's a big enough concern the Fed should stop purchases right now. 40% think it should prompt the Fed to raise rates now.
And a lot of people, if you hadn't watched my previous videos, they've kind of been worried about, oh my God, this is going to be the 1970s where inflation was through the roof, and so they raised interest rates really high to try to get it under control, which they end up doing. And understand that is not possible. Like, that's the difference in what we're facing now is, the interest rates, you can see by the chart here, have been going down since the 80s steadily, as you can see over the right. It's at 0. And you see in the 70s here, the interest rates were absolutely skyrocketing up. But the reason why they're going up so much, they were trying to fight inflation as we put the CPI data on top of this. You can see right here, as inflation rose, interest rates rose, and then as inflation decreased, interest rates decreased. And you see right now, though, we're not doing anything. The Fed rate is flat, and inflation is at a 30-year high right now, year over year. And so you don't ever have to worry about collecting 5 to 6% on your savings accounts or 10% on your CDs or anything like that. Those days of being burdened with collecting interest and passive income have gone, and ships have sailed forever. That would never, ever, ever happen, okay? So if you've never experienced it, you never have to worry about collecting a nice little percentage of passive income again on your savings account and CDs, because they will never, ever be able to raise the rates that high again, because if you look at the debt, wasn't 28 trillion or whatever we're at now back then, wasn't even close to that. Okay, that debt has been driven up in the last 20 years. And you looked at the rates. What's the rates been doing? Heading down. If they raise the Fed rate up, it's basically raising the borrowing rate up at the same time, and they will bankrupt the country, because I think 1 out of every $7 already goes towards the interest payment every month just on the federal debt. So, and another thing is, they can't lower the debt or even, balance a budget anymore, because we have a debt economy, right? Not only personally, but at the government level, it's all about how much debt can we take on, right? That's how we consume everything, credit cards, mortgages, everything. And the government puts so much money into the economy, and so many companies are dependent on it from taking our tax dollars. Big oil and gas, alternative energy, car companies, they all get our tax dollars, not only from us paying for their services and their products, they get it from the government as well as subsidies. And then of course all the, Social Security checks and the Medicare they pay for, and, Medicaid and all this stuff that goes into the system. If they were to ever balance the budget again or even talk about it, the whole system would just crumble. And so trust me, we'll be at, 40 trillion within 10 years, easy, maybe even less than that. And so don't even sweat that. Don't worry. It's going to keep going up, okay? Don't have to worry about that. Now, got off track a little bit. Now let's get back into, so why, how can the stock market continue to grind all-time new highs out every couple of days, right? New high, pulls back a little bit, new high, pulls back a little bit. How is that possible when costs are going through the roof right now? You listen to any earnings call, this is what all of them are talking about, is the input costs are so high, they're trying to pass on, and they have to pass on to us, right? Which means we have less money to actually put in the economy, because earnings or wages only went up 1%, well, inflation's up 5%. So let's do the math here. 5 minus 1 is 4%. So next year, and the rest of this year, you will make 4%, and I will too, 4% less money, okay? You'll earn it, but an extra 4% will get burned up in costs, whether it's your bills to pay your energy, fast food, grocery stores, at the gas pump, wherever. That's what's going to be happening going into next year, okay? And so how is it possible to keep grinding higher? And that's very simple. Because 40% of the money in circulation in the United States right now was created in the last 13 months. Look at this chart right here, guys, okay? I mean, that is insane to think. That's 2020. You see the big old going straight up the line? This was all the money they were printing. So this meme going around about Jerome Powell right here, just shooting money out right and left, is not a joke. It's legit. That's exactly what they've been doing since the pandemic. I mean, think about that. 40% of the money in circulation in this country was created since the pandemic. That is mind-boggling. We've been around a long time, guys. Okay? But it's not just that. Like I said, what are we? We're a debt-ridden society, right? So how else do we keep the markets going higher? We leverage ourselves to the hilt, as you can see right here. Obviously, we're up here. We've come down a little bit. You see those peaks right there. And this is usually when you start to see it come down, people start to get worried. But as you saw, and I said this about a month ago, I said, let's see if it turns back up. And it did, okay? And so you can see a whole lot of margin debt being taken out right there. And what we don't know about this chart, you can see the little turn back, is whether or not, eventually, of course we will, end up having to have a sell-off. But right now the party's still going. But this chart's done a pretty good job of being a predictor. When you see margin debt decrease, it usually ends up preceding the stock market turn. And here you go, margin debt and the S&P 500. As margin debt goes up, so does the S&P. And where I have the arrows at, that's what I was talking about with margin debt decrease and preceding a market sell-off. You can see multiple times this has happened. And so, of course, like I said, the crazy amount of liquidity still in the market, plus with all the leverage we're using, just continues to grind it higher. The other thing is, don't forget, greed runs the market, right? That means the institutions. They are going to get every penny they can out of this thing, because they know what's around the corner in 2022. They know the bottlenecks aren't clearing up. means supply chains are still going to be a wreck going next year. Inflation, you hear them say, isn't decreasing anytime soon, so you don't have to worry about that. And so they know what's around the corner. And the fact we haven't had a 10% correction on the S&P since last year sometime, I mean, it's been a long time, okay? And so, you know, they know what's around the corner, and so they're going to try to just keep pushing it. And don't forget, they got year-end bonuses. They got to get that too, okay? They got to get every single morsel or penny they can out of it. And so that's, you know, why it continues to grind higher. I'm not surprised. I said it last month. That's what was going to happen. They're going to continue to grind this thing higher and higher. You know, it's not guaranteed, but you're seeing it right now, okay? And so with Jerome speaking tomorrow, I said, wait a minute, let me look at when he spoke, so I was at 2 p.m., and see how the market reacted, to see if there's maybe a trade out of this thing, you know, maybe we'll make a little money on it and stuff. And so if you look at the charts, I put in sequential orders. You can see this is March. You can see it pops when he speaks at 2 p.m. and then sells off at the end of the day. Then you got another pop when he speaks at 2 p.m. Then it sells off even below that by the end of the day. Then it drops as soon as he opens his mouth up, but then makes a comeback by the end of the day. And then if we go on to see what happens in July, you can see right here, huge run up, right? And then sells off at the end of the day. And then in September, it did a huge run up when he opened his mouth up and then sold off immediately to go back below where it was at when he started talking. And so it's really a 50-50 crapshoot, right? And tomorrow is going to be much different because everybody's expecting him when he opens his mouth up, he's going to say we're finally tapering and maybe even raising rates earlier than he originally said he was going to do. And so who knows? Most people say this is priced in. I mean, we know it's been coming for a long time. We kind of knew it was coming in November. So it shouldn't be a surprise. But as you can see, the markets right now are all over the place. They'll open up green, then they'll go red, then they'll close green, vice versa. So you really don't know, you know, which way is up and down right now, or which way it's going to go. But I will say there's two, you know, things that got people worried in the short term here. I'm talking about probably, you know, November-ish, December-ish sometime, really, is what you see going on with the VIX and then earnings compared to inflation. And you see the chart on the VIX here. When it gets between 14 and 16, right, these are support and resistance levels, that's when you see a nice pop. When the VIX pops, that means there's a sell-off in the market because the volatility is big. And what have you seen recently? The VIX going up, a little bit down, so it's kind of preceding what normally happens before you get that big pop up on the VIX. And then the other one is the S&P 500 reported earnings yield minus CPI inflation rate, okay? The little colored lines coming down, that's a huge sell-off in the market. And when it gets below zero, which is where it's at now, you can see that precedes a big sell-off in the market. It can take time. You can see how far down those lines go. And neither one of those obviously are guaranteed, but when you see the VIX chart, you pretty much can guarantee there's going to be a big pop-up coming up here in the next few weeks, you would think. We shall see on that. And of course, with the last charts, no guarantee. But they are indicators which people like to use, and so that's why people are nervous to really be getting in at this time in the market, especially when you're at all-time highs anyway. And that may be why you've seen a lot of SPAC stocks and Russell 2000 stocks actually going up over the last couple of weeks, right? Because they've still been just beaten down into the ground, okay? So people are coming into small caps, maybe medium-sized cap companies versus the large caps. And so kind of may explain that a little bit as well. And you've seen that a lot lately. And so, you know, just want to put the data out there to you. Who knows what he's going to say tomorrow? He might just punt again. I mean, because right now we got a bunch of countries already started in September, October on their buybacks and raising rates to try to fight inflation in their countries. You know, we'll see if they're right and Jerome Powell is wrong or vice versa. But I think it's about time he starts doing something and understand what that means is if he does that, that takes liquidity out of the market. Those will stay around to the end. I'll say this. Liquidity out of the market, because if they're not buying the bonds, that means people in the stock market are taking money out of the market and putting it into the bond market. Don't forget, the bond market is much bigger than the stock market, okay? And so, you know, we'll see what happens to that, you know, if bond prices continue to rise or not, gain strength going into next year. Because remember, that's the other thing that keeps the stock market going. It's the only game in town. Because with bonds, if you're getting 1.5%, and inflation is 5%, you're losing money, right? And so it helps be the only game in town. And so, you know, we'll see what happens. I hope you got some out of this. Hit the like, subscribe button if you did. And don't forget to hit that link down there in the bottom. Sign up for a BlockFi account to earn 9% starting November 1st on your stable coins, 9.5% on your Tether, and 4 to 5% on your other cryptocurrency, as well as earn the 1.5% back on Bitcoin for every purchase you make on that credit card, guys. I will see you later.